the raging debate over the second bank of the United States. The Republicans are Jacksonian. They're scared stiff of the big money of New York, et cetera, and the Democrats of the urban milieu push against that. How is this battle going to play out? Are we still in fear of the second bank of the United States?
Well, Tom, I love the history lesson, and the Hermitage is a beautiful spot. Andrew Jackson was a super controversial president. But today we're faced with a situation where I think after 10 years of easy money and amazing amounts of fiscal stimulus, I think some management teams have forgotten their prudential obligations to their depositors and their shareholders. So we have a real laxity in risk management in some of our financial institutions. And perhaps we've got laxity in the supervision of those institutions as well, particularly in the case of Silicon Valley.
Do we need to treat the banks such as Delphi that you ran in Arkansas? Do we need to treat smaller banks like the bigger banks out of Dodd-Frank? Do we need a one regulatory system? Is that the lesson learned?
Well, I think some of the costs of Dodd-Frank on small banks made them less competitive, harder to earn a return on invested capital there. And that's why Democrats and Republicans came together, as you noted earlier, and Barney Frank supported it to make modifications in Dodd-Frank's regulatory burden on small financial institutions. I don't think that in any way, shape, or form reduced the obligations of the bankers for their risk management legal requirements, or for the supervisors to do their routine job on a quarterly basis to make sure the system is safe and sound.
Congressman, you keep mentioning the supervision, and I'm wondering how much you fault Jerome Powell's Federal Reserve for the lack of supervision that you're talking about.
Well, the Silicon Valley Bank clearly had risk management problems in their strategy about short-term deposits that were uninsured, invested in long-term Treasury and mortgage securities. And the California bank regulators, the state bank regulators, were the principal regulator, backed up by the San Francisco Bank of the Fed. And so they do have a supervisory obligation. This bank grew very, very fast over the last 2 years, and that is usually a huge red flag to supervisors. And perhaps they could have intervened and helped the management team steer in a much more safe and sound direction.
Do you think that things have stabilized enough that you have confidence, given the intelligence that you've received, that the stability in the financial system is sound and that we're unlikely to see something else like this in the near future?
Well, you never know what's going to happen in the future, but we do have a safe and sound banking system with good capital and good earnings and generally good liquidity planning across the nation. I think that's clear over the past decade. But I think with low interest rates at zero and then a sharp increase in short rates, some management teams were not prepared for handling that in the right way. And so we may have bumps in the road as a result of that. And you've certainly seen that in the case of Silicon Valley last week.
Congressman, you've come on the show before and talked about how inflation is a tax on the poorest members of our society, about how when inflation gets this high, it becomes punitive for so many families. How important is it, from your vantage point, to see the ongoing rate hikes or some sort of continuation in monetary policy, regardless of some of the concerns that we've seen in the financial system? Or do you think that this is the clarion call that perhaps what we've seen is enough?
Lisa, it's a tough question. As I've said on your show before, that's the anguish of central banking, to try to balance these factors. But look, the Fed has a central obligation to all of us and our families of price stability. So they've got to have that as their principal mission, but they'll look at financial fragility as well. But I think the Fed should stay on track using their best judgment and looking at the data and make sure that they can beat this inflation and get it back down to closer to their target of 2%.
If we get to some new insurance regime, the belief here, Congressman, is the banks are going to pay for it, not the taxpayer. I get that idea. But is Arvest Bank of Bentonville, Arkansas, are they going to have to pick up the tab for the irresponsible behavior of West Coast technocrats?
Yeah, Tom, this is a great question. And, back in 2008 and 2009, we moved to risk-based premiums based on the bank's camel rating, their risk rating by the regulators. That was a step to making sure that people who run a poor shop pay a higher deposit insurance premium. Now the question is, should we have some sort of premium on top of this risk-based premium that would cover these sorts of situations where a bank is determined to be, like they did this weekend, systemically important, and yet we're insuring deposits for which no premium was paid. I think this is an important area for policy to consider. We looked at it back in 08 to 10. I think we need to look at it again in the face of this new banking system. And Twitter runs, which is what was precipitating this collapse last week.
Let's meet in the rotunda. What is the common ground, Congressman Hill, of you and Senator Warren?
Well, I think both Senator Warren and I want a safe and sound banking system. We want to make sure, for example, in the digital asset space, that the rules of the road are clear and that we don't have this speculation that we've seen in that market and that criminals are prosecuted and fraudsters are prosecuted. But I would say to Senator Warren, look, we have a robust regulatory system with plenty of rules on banks of all sizes. What we need to see is vigorous supervision of those banks by their primary regulators at all stages of the economic cycle.
Does that mean, Congressman, walking back some of the deregulation we saw go through in 2018?
You know, Jonathan, I don't think so, because it was a very bipartisan, very modest tiering of the regulatory structure that came out of Dodd-Frank. I don't think you can lay I don't think you can lay the collapse of the banks last week at the foot of 2155. I just don't think that's relevant. I think what is relevant is risky management practices with or without Dodd-Frank and lack of supervision by the primary regulator.
The reason I ask that is because the regulator used the systemic risk exception to make depositors whole. And Congressman, what we've acknowledged over the weekend is that basically all banks in America carry some degree of systemic risk. So should they all be regulated in the same fashion regardless of size?
Well, I think tiering is important, but that gets back to Tom's good question about deposit insurance. Should we have a premium on top of the base risk-based premium that somehow reflects that systemic risk? And that would be something that somebody would have to think through analytically about how one would assess that in a fair and balanced way. But that speaks to this question, because you're right, the regulators this weekend determined that Silicon Valley's reach went well beyond its branches in California and New York as it related to the economy.